Warning: 2026 is shaping up to be unlike anything we've seen in modern financial history. Forget the mild recessions the economists keep promising. The reality is far more ominous. The stage is set for a collapse that could surpass 2008, and the signs are already flashing in plain sight. Let me take you through exactly what's happening, why the experts are wrong, and what this means for your money before it's too late. January 2026, and the Shiller PE ratio has already reached 41.2. That's not just high, it's alarmingly high. The only time it was higher in history? December 1999, right before the dot-com crash obliterated 78% of the NASDAQ. But 2026 isn't a repeat of 2000 or 2008. It's a convergence of multiple crises, all interacting to amplify the damage, and it's about to hit the global economy in ways most people aren't even considering. Economists continue to tell us that 2026 will see modest growth. DOT predicts 1.3%, Morgan Stanley calls it a moderate expansion, JP Morgan suggests a 33% chance of recession. These numbers sound reassuring if you ignore history, because these are the same institutions that said subprime was contained in 2007, that the new economy had eliminated recessions in 2000, and that markets were priced correctly before every major collapse. Their models fail when multiple systems break simultaneously. The truth is, 2026 is not a single crisis. It's four crises, each powerful on its own, each feeding into the others. Understanding them is essential, because ignoring them is financial suicide. Crisis 1. Commercial real estate. In 2026, $945 billion in commercial real estate debt matures. Add the $530 billion that matured in 2025, and you're looking at nearly $1.5 trillion in refinancing obligations at interest rates roughly double what borrowers initially paid. Here's the math. A building financed in 2021 at 3% now faces rates of 6% or more. That alone doubles debt service payments. But building values have plummeted as vacancy rates soar. Nationally, office vacancy is 20%. In San Francisco, it's nearly 30%. And Austin is at record highs. Borrowers owe more than their buildings are worth, payments have doubled, and buyers are scarce. The only logical outcome: defaults. Banks are already feeling it. CNBS reports commercial property delinquency rates at 7.1% in October 2025, up from 6.7% 2 years prior. 278 banks have dangerously concentrated exposure, and over 900 still carry commercial real estate exposure above 300% of their capital. In 2008, residential mortgages triggered the collapse. In 2026, it's commercial real estate, but the mechanism is identical. Losses could exceed the $400 billion absorbed in 2008. Crisis 2, the stock market bubble. The Shiller PE ratio at 41.2 is the second highest in 140 years. The only higher reading was 44.19 in December 1999. And the Buffett indicator, total market capitalization relative to GDP, now sits at 227%. Anything above 160% is considered dangerously overvalued. 7 mega-cap tech stocks dominate over 32% of the S&P 500. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. This isn't diversification, it's concentrated risk disguised as an index. The AI boom driving these valuations mirrors the internet boom of the late 90s. Revolutionary technology, real productivity gains, parabolic stock prices, followed by catastrophic crashes. At 41 times cyclically adjusted earnings, the market is pricing perfection, not growth, and perfection doesn't exist. Historically, when CAPE exceeds 30 for extended periods, corrections of 20% or more are inevitable. 2026 is no different. Crisis 3, the debt doom loop. U.S. national debt now stands at $38.5 trillion, up from $36 trillion at the start of 2025, adding roughly $2 trillion per year. Interest payments alone reached $1.05 trillion in 2025, the second largest federal expenditure after Social Security, surpassing Medicare and defense. If interest rates rise, every 1% increase adds approximately $380 billion to annual interest expenses. The cycle is simple and brutal. Higher debt leads to higher borrowing, which pushes rates up, which increases interest expenses, which inflates deficits, which requires more borrowing. The federal government will spend $1 trillion in 2026 just servicing debt, leaving nothing for infrastructure, education, or defense. Unlike 2008, this crisis is sovereign, not private, and the entity that would normally solve the problem, the federal government, is part of it. The reinstated debt ceiling at $36.1 trillion has already been breached, and another showdown looms. Moody's has downgraded the U.S., and political dysfunction reduces the chances of coordinated action. Crisis 4, the consumer breaking point. Auto loan debt reached $1.68 trillion with an average monthly payment of $752. Subprime auto delinquency rates are at 6.8%, the highest since records began in 1994. Over 1.8 million vehicles were repossessed in 2025, the highest since 2009. Nearly 30% of trade-ins are underwater, with negative equity averaging $7,200. Credit card debt exceeds $1.12 trillion, with average APR above 20% and delinquencies climbing. Student loan repayments have resumed, stretching consumers further. Car loans often signal the last stop before mortgage and credit card defaults because people prioritize transportation to work. Subprime borrowers breaking at these rates is a warning for all income levels. Stress is about to cascade upward. Here's how these crises interconnect. Commercial real estate losses hit banks, banks tighten lending, the economy slows, unemployment rises, consumer defaults spike, bank losses multiply, and the cycle accelerates. A stock market correction of 20–30% reverses the wealth effect, prompting reduced consumer spending, declining corporate earnings, layoffs, more defaults, and further bank stress. Unlike 2008, the government can't act aggressively. Deficits are high, interest payments consume trillions, inflation is above target, and the Federal Reserve is trapped between combating inflation and preventing recession. The tools that worked in 2008, massive stimulus, zero rates, quantitative easing, are far less effective in 2026. This is why 2026 could be worse.
Now, let's confront the objections. The economy is resilient. GDP growth is positive. Unemployment is low. That's exactly what 2007 looked like before the collapse. Recessions are only visible in hindsight. Banks are stronger now. Maybe, but not for concentrated commercial real estate exposure. The Fed will save us. Rates can't go to zero, inflation remains above 2%, and debt to GDP is already 120%. Printing money risks currency collapse. This time is different. AI and technology are real, but valuations at 40 CAPE and 227% Buffett indicator are stories, not earnings. Reality always intrudes.
So, what can you do to survive 2026? First, stress test your portfolio for a 30–40% drawdown. If you can't stomach it, reduce exposure now. Second, build 6 to 12 months of cash reserves. Liquidity is king. Third, reduce exposure to rate-sensitive assets, long-duration bonds, leveraged companies, commercial real estate. Fourth, diversify geographically. International markets trade at significant discounts. Fifth, consider hard assets. Gold, for instance, hit record highs in 2025 as central banks diversify. Sixth, watch the signals: bank earnings, CNBS delinquency rates, auto loan defaults, the yield curve. The historical pattern repeats: excess, euphoria, exhaustion, collapse, reset. In 2026, excess is AI stock mania, commercial debt refinancing at double rates, government debt nearing $40 trillion, and consumers maxed out. The cracks are forming now: CNBS delinquency, auto repossessions, bank vulnerabilities. Experts still say contained or this time is different, but the pattern never changes. Lehman Brothers collapsed in September 2008, but warnings began in 2006. The warnings for 2026 began in 2023, and the fuel is stacked. The match is about to strike.
You cannot run 41 CAPE, 227% Buffett, $1 trillion in annual interest payments, 20% office vacancies, and record consumer delinquencies indefinitely. Something gives. The difference between 2008 and 2026 is the response capacity. In 2008, tools were effective. In 2026, fiscal limits, high interest, and political dysfunction blunt the response. The only choice is preparation. Cash provides optionality. Low debt offers flexibility. Diversification gives protection. Hard assets act as insurance. These aren't predictions. They are survival strategies.
The risks are clear. Shiller PE at 41, Buffett indicator at 227%, $1 trillion in annual interest, record auto delinquencies, commercial real estate stress. Any one of these could trigger a collapse, but together they make 2026 potentially worse than 2008. Will you be ready, or will your wealth become part of the next reset? The data is public, the warning signs are flashing, and the match is in place. The choice is yours. Believe the experts claiming a soft landing, or trust the numbers pointing to an imminent crisis. History doesn't repeat exactly, but it rhymes. Right now, the rhyme sounds dangerously like 2007, and 2026 could be the year the system pays the price for 2 decades of easy money.